Okay, good to see you. I don't believe at this level you understand what we mean by accounting period. Okay, of course, you know your concept and conventions. Okay, periodicity. Okay, then you must understand that in reporting activities of a business, there's usually a coverage period, a period that you're trying to give stewardship of. All right, so depending on the organization anyway, so usually it's a 12 calendar month or a 12-month calendar. How do we put it? Okay, let's say January to December. Okay, so this is like 12 months, so we cannot say 1 year, right? Okay, that is for the 12-month period. Okay, and that does not mean that you don't report on monthly basis. Some organizations do monthly reports. Okay, they do monthly reports. Okay, some even do quarterly reports, and then we have half-year reports, and then I have the annual reports. Okay, so what we're saying is that you can tailor your policy such that every month that's of course preceding, because activities for January will be reported in February, activities for February will be reported in March reported in April in May, and all that, right? So that is it for monthly. Then you can now say, okay, let us see what we have done every 3 months. That's quarterly. And then after that, you still continue with your monthly report, and then you want to see what you have done at the end of what? The 6th month, which is half of the year. You want to see what you've done, want to see what you've performed, okay? Then it goes to half a year. And then after that, you continue with your monthly report again, and then your quarterly report. And then at the end of the period, you want to know what you've done for what? A year, 12 calendar month, right? Okay, but then you must also understand that some events that can even, warrant you reporting, more than 12 months. All right, sometimes on demand and all that. Okay, but that's not the area we're going to. But then you must understand that. But typically, going by the concept of periodicity, okay, we have monthly. In fact, it's supposed to be 12 months, but management, based on policies, okay, can now decide on the period of the report aside from the routine yearly report. Okay, then like I said, events can now warrant the demand for what reports to be prepared at an extended period, maybe over 12 months, maybe 12, 13, 15 months and all that. Okay, so the point I'm trying to make you understand here is that as an accountant, you must understand that in reporting the activities of an organization within a particular period, you must ensure that you capture, activities relating to that period. Okay, so long as the monetary measurement of that transaction fall within that period or relates to that period, it is expected that it should be fairly reflected in that period of reporting. Okay, so if you're reporting on monthly basis, for instance, so you should expect, or it's expected that activities relating to January should be captured in the report for January. If you're reporting for February, activities relating to February should be captured in the report for February. If you're reporting for a year, activities reflecting or activities in that report for a year should reflect what has happened for that very year. So in that essence, or with that in mind, you must understand that sometimes transactions occur in form of what? In form of what? Prepayments, okay? Or in form of what? Accruals. So when you say prepayment means payment in what? Advance. Okay? So it can be payment in advance or receipts in what? Advance. So that means you can make payment in advance. You can also receive money in advance, right? So we have accruals. Accrual can be what? Payment in what? In arrears or receipts in what? Arrears. So the point I'm trying to make is that sometimes while reporting activities of a particular period, some transactions, okay, that have monetary what? Values are not expected to be captured, okay, as income or expense item for that what? Period. So what I'm saying is that, okay, for us to also be in line with the prudence concept or the matching concept, okay, we must ensure that income that we are capturing is reflecting what has happened for the period, and then expense that we are capturing is reflecting that has what happened in that what period. Okay, so where it is not an item that should be reflected in that period, then we must make appropriate what? Adjustments, okay, to capture the transactions fairly. So that's why, of course, every business must have what? Proper policies to help them, capture certain transactions, okay, to give a fair view of that very what occurrence. Of course, sometimes there are some items that the reporting standard, of course, you know what I mean, reporting standard. Reporting standard here, I mean IFRS, okay? IFRS represents International Financial Reporting Standard, okay? Some items, okay, you might not have an explicit or might not have a recommendation on how to treat certain, transactions. So by way of policy, the management must now find, a way to treat that transaction, okay, to give a fair position, okay, without misleading what users of the same what information. Okay, and then adjustment as well. Of course, it's not only in the area of payment in advance or receipt in advance or payment in arrears or receipt in arrears. Of course, adjustment can also set in where mistakes. When you say mistakes, okay, mistakes have been identified. Of course, we refer to them as what? Errors. Okay, so you can have errors. You can have errors in current reports, you can have errors in previous reports, but we must also look at the materiality for disclosures. And then even at that, once you identify them, you must reinstate them. Okay, by reinstatement, I mean you must, adjust for them to reflect what the true and fair what position. So it could be a year before, which is prior year, okay, and then it could be the current year. But the idea is that where errors have been identified, we must find ways towards fairly reinstate it and then disclose, the nature of such errors where we see that what it might affect what the user's understanding of the same what information. So you must also look at the recommendation of the board. Okay, we have international accounting standard 8, that's IAS 8. Okay, so this is on what they call accounting policies, estimates, and what? Errors. Okay, so you should look at that and then understand what the board is recommending regarding policies, estimates, and what? And errors. So now for us to proceed, my concentration is on what? On what? On prepayments and what? Accruals. Okay, so when I say payment in advance, what do I mean? What I'm saying here is that you are paying for what? An expense that you have not yet incurred. Okay, sometimes employees will, apply for salary in advance. Okay, so that means that what? They have not earned that salary, but you're paying them. Okay, so that's payment in advance. Do you understand? So the idea is that you have not incurred that expense as a business, as an entity, but you have made payment for them. Okay, so we say payment in what? Advance. So payment in advance typically, okay, represents assets, current assets. Okay, of course, if you're giving your employees salaries in advance, the interpretation is that what? The employees are now owing the what? Business. Remember, those owing the business are debtors. Okay, and debtors are what? Assets, current assets here. So whenever you make payment in advance, okay, it becomes what? A current what? Asset. But in this case, receipt in advance, it means that you have received an amount of money that you have not yet rendered the service for. Now take for instance, your client is paying you for a service that you are yet to render. What's the interpretation? You are not the one owing the what? Client. So your client is more like a creditor in that what? In that sense. So when you have receipt in advance, they are what? Liabilities. We call them current what? Liabilities. All right? And then we have payment in arrears. When I mean payment in arrears, I mean that you have incurred the expense, but you are yet to make payment. Let's say that's what? Your rent is due for a particular period, but you are yet to pay. What's the interpretation? It means that you are owing your landlord, right? So your landlord is more like what? A creditor to you. So payment in arrears represents what? Current liabilities. Okay? Now when you say receipt in arrears, what does that mean? Okay? So what we're saying here, we're just saying incomes. Let's use the right word. Income in what? Arrears. So what we're saying is that you have rendered the service, but you have not yet received the money. Okay? So your client, are you with me now? Or someone ordered for your service, you rendered the service, and that guy is supposed to pay you, but the guy is yet to pay as at the time you are reporting. So the interpretation that person becomes a debtor, right? Aha. So in that case, receipt in arrears represents what? Current what? Assets. Okay, so typically this is the treatment of what? Payment in advance, receipt in advance, accrual is payment in arrears, or receipt in what? In arrears. But sometimes you are in what they call an incomplete record setting, where information is not well kept by the person keeping the record for the business. So you are now faced with using opening balances and closing balances to prepare income statements, what we call incomplete what? Records. Of course, at this level, you know what incomplete records are. Incomplete records simply represents an accounting system where they do not keep what or they do not follow the bookkeeping procedures. Okay, they don't follow the proper bookkeeping and accounting procedures. Okay, so in that setting, you have incomplete records. So as a professional, when you go into that setting, there are processes, there are ways in which we use incomplete records to prepare what the needed what financial what statement for the owners of the what business. So in that scenario, you are likely to come across opening payments in advance and closing payment in advance, or what I call payment in advance, or let's say prepayment for a previous year and prepayment for a current year. Remember I told you that if you are in 2016, for instance, whatever you have as the closing balance of 2016 will be the opening balance of 2017. So closing balance here becomes what? The opening balance here. Okay, so closing balance for this guy here becomes the what? Opening balance for 2018. So you must understand that fact. So where you're having incomplete records scenario, you're like to have closing balances for different years. So whatever year you're preparing the account for, you should be able to compare your balances to have the actual what value to be captured, okay, for the period that you are recording. So in that scenario, you can have prepaid expenses, okay, at what? Beginning of the what year. You can have prepaid expenses at the end of the what year. So this is more like the year that you are reporting, okay. And then you can also have what prepaid what income at the beginning of the what year, and then you can have prepaid what income at the what end of the what year. Okay, so the same thing for what I call accruals. Okay, you can as well have accrued expenses at the what beginning of the year, accrued expenses at the what end of the what year. You can have what accrued income at the beginning of the year. You can have accrued income at the what end of the what year. Okay, so typically what we do is that the accrued expenses, or let's just use the word accruals at the end of the year increases the income or expense item. This is what I'm saying. Let me take this out. This is what I'm saying. So if you have, say, rent paid for 2015, let's say 100,000. Then you now have what? Accrued rent as at end of what? 2015, let's say 5,000. Now let's assume you have accrued rent as at end of 2014, 4,000. You can see that there's an opening accrual for 2015 by virtue of the closing accrual of 2014. Okay, so what I'm saying is that this one at the end of the year you are reporting, which is 5,000 here, will increase the rent you have to charge for 2015. So what that means that the rent you're charging for 2015 will be 100,000, okay, plus what? 5,000, then minus what? 4,000. That means the rent you have to charge for 2015 will be what? 101,000. Okay? Why this 5,000 here will be what? A current what? Liability. Okay? So if it were to be an income item, okay? If it were to be an income item, okay, the accrued income at the end of 2015 will increase the income for 2015. The accrued income for 2014 will decrease the income for 2015. Then that accrued income for 2015 will become what? A current what? Asset. Because here, this 5,000, okay, this 5,000 in the year of reporting 2015 is a current what? Liability. But if it were to be an income, okay, it will be what? A current what? Asset. By virtue of the fact that it's an income that is accrued, it means that what? You have worked for it, but you have not what? Received. So you have earned it, but you have not received the money. So that guy is owing you, it becomes an asset. But by virtue of the fact that it's an expense, you have incurred it, but you have not paid, okay, it becomes a liability. That's why accrued expenses are liabilities, accrued incomes are what? Assets. Okay? Now, for that of what? For that of what? That of prepayment. So when we say, let's use the same rent now. Let's say rent paid for 2015. Let's still leave it at 100,000. But in this case now, we'll say what? Prepaid what? Rent. Okay? At the end of what? 2015. Let's leave it at 5,000. Okay? Prepaid rent at the end of 2014. Let's leave it at 4,000. Okay? Now, prepayments, okay, at the end of reporting period reduces the income or expense item. So what I'm saying is this. So this is prepayment. So that means the rent that we're going to charge now will be what? 100,000 minus what? 5,000 plus what? 4,000. Okay? So what do you have? This is what? 100,000. 100,000 minus 5,000. That's what? 95,000. 95,000 plus 4,000. That's what? 99,000. So that means by virtue of the prepaid rent adjustment, what we're going to charge for rent in the year of reporting 2015 will be what? 99,000. Okay? And then this prepaid rent 5,000 for the year of reporting will be what? A current what? Asset. But if it were to be an income, it will take the same adjustment, only that what? The 5,000 will become what? A current what? Liability. Now what I'm saying is that by virtue of it being an expense, I say prepayment at the end of a particular period reduces the income or expense item. Okay? So that means at the beginning it will increase it. But now what I'm saying is that if it should be an expense, by virtue of this illustration now, you can see that the prepaid rent at the end of the reporting period is reducing the rent for the period, which is 100,000 minus 5, which is what? 95,000. And then the one at the beginning of the period, which is the end of 2014 here, is increasing at 99,000. But for the reporting period, which is 5,000 here, because it's an expense which has been paid for in advance, it means we have not incurred, but we are paying for it. It becomes what? An asset. Okay, current asset. But if it were to be an income, of course, let's say rental income, it would have been the same adjustment, but this 5,000, which is now prepaid rental income, will become what? A what? A current what? Liability. By virtue of the fact that what? You have received the money, but you have not yet what? Earned it. So it's prepaid. The person is paying you the money in advance for a service that you have not rendered or for what you have not yet earned. So in that case, you are owing that person. That person becomes what? A creditor. So that's a liability to you. Remember your asset, liabilities, income, and expense. I already explained that. Liabilities are like your obligations to what? Others, to outside, to third parties, to, So in that case, now when we say prepaid income, that means you're earning an income that you have not yet, you're taking money for an income that you have not yet earned. You've not received, you've not rendered the service, but you're receiving the money. So by virtue of that, you are owing the guy which you're here to render the service to. So that becomes what? A liability. So you must understand how to treat prepaid items and what? Items of what? Of accruals. Okay? Especially in what? Trying to what? Match your incomes with your what? Expense to give a fair position of your what? Of the profit that has been what? Made for what? a particular year. So basically, this is what I intend to share with you today. Prepayments and accruals. Of course, accruals are also called outstandings. If you don't want to call it accruals, you can call them. If you don't want to call it accruals, you can say outstandings or owings. Okay, so they use those words interchangeably. So there's already a class on accruals and prepayments on Jaros Consulting. So I'm just trying to look at the practical aspect here. So I'll advise you to take that class and then combine with this class, okay, to have a better understanding of accruals and prepayment. So if you have questions, you can reach me on the numbers displayed. I'll be there to reply you with the right answers. So let's take this quick question, okay, straight question, and then so we can have an idea of what I'm talking about here. We have the following is the trial balance of Agbenuga Ventures Limited for the year ended 31st December 2017. So we have property, plants and equipment, sales, purchases, share capital, payables, bank loan, VAT, cash at bank receivable, administrative expense, accumulated depreciation. So we have the trial balance there. And then we have additional information. The business is to pay 2,500 naira. Sorry, 2,500,000 commission to Blinks Limited. The transaction, which is also subject to withholding tax, has not been captured. Then we have, of course, withholding tax. I've already taught classes on withholding tax, as account for withholding tax, so I expect you to take that class here. Okay, we have 2. The business rented a new office on the 1st of the 7th month. Okay, the business paid for a year at a cost of 1,500,000 per annum. So of course, I want you to understand what they are trying to test there. Okay, the business is renting an office space there, and then they paid for a year. Okay, and then as you can see, it's half of the month. Okay, so what does that tell you? It means that if they're paying for a year, you can't charge all the 1.5 for that year that we are reporting, because if it is half of the month, it means the remaining half will flow into the following month. So there's a prepayment there. Okay, so if the year there, I think it's 2017. Okay, and then they are saying that they rented an office space on the 1st of the 7th, but that's July. So July, August, September, October, November, December, that's 6 months. And then they paid 1.5 for a year. A year is 12 months. So if the counting is beginning in the 7th month, which is July to December, which is 6 months, so what we are supposed to charge for 2017 there will be half of 1.5 million, not 1.5 million. That's about 750,000. You see? So that's a practical way of testing prepaid expenses. Okay, we've had that happen, sometimes in the office, you pay for rent, and then the rent is not for that year of accounting. Okay, and then you know that what do you call it now? The year of the rent also flows into the following year. And then don't forget, accounting periods. Some organizations don't do January to December. Okay, there are some that flows from a particular period. You can have July to June. Okay, so understand that it's not compulsory that your accounting period must be January to December. The accounting period can be maybe March, and then you start counting from March till, so we have March, April, May, June, July, August, September, October, November, December, then January, February, and of course 12 months. So if it begins in March, it will end in February. So some business organizations, they don't have January to December. Do you understand? So of course, sometimes nature of business will determine that. So don't think that accounting year must be January to December. No. Some businesses don't do January to December. Okay, they select months in between the year to end another month in between the year. So you must understand that. Okay, so the next one, we have number 3. The office assistants have claims of 125,000 naira spent from their personal purse while moving equipment to the new office. This is yet to be settled. What are they trying to test there? Okay, what they're testing here is accrued expenses. Okay, so what they're saying here is that these guys I've spent 125,000 on behalf of the business, but the business is yet to what? Pay. So technically the business is owing them. So what? That's like a liability, right? So that's accrued what? Expense. So that's just another. The next one we have it is a policy of the business to depreciate non-current assets by 20%. Of course, you should know that by this time, at this level. So we have you're required to prepare the income statement and the statement of financial position for the period. Okay, so let's quickly solve this question. I already explained that accounting years does not have to be January to December. It can flow from another month in this year to another month in the following year. Okay, let's quickly solve this question. So what do we have here? We have Agbenuga Ventures Limited. Okay, so we have income statement. Okay, for the year ended 31st December 2017. So let's quickly do this. We have notes here. Okay, so let's say this is our our turnover, and that's note 1. So let's put our note 1 here. So what is the turnover here? Here I can see sales. Sales is the only thing here. So we have sales. What's the sales there? 96 million. So we have 96,000. So quickly, we have it as 96,000 here. So we have our what? Cost of what? Sales. That's note 2. So let's look at our note 2 here. Okay. So what are cost of sales here? I can see purchases. Okay, that's about the only item here. So what are the purchases? So we have purchases there. Purchases according to the question is 57,500. Okay, so we have 57,500. So if you take this out, what do you have? 0 minus 0, 0 minus 0, we have 0. 10 minus 5 here is 5. Okay, so we have 5 here. 15 minus 7 here, I think it's 8. And then we have 8 here. 8 minus 5 would be what? 3. So we have 38,500. All right, so now this 38,500, what do we call it? Let's call it our what? Gross profit. So is there any other income? No question. There's no other income in the question. Okay, so let's go. So we have total what? Expense. So let's call this note 3. So we have note 3. All right, so what's there? I can see administrative expense there, 11,270. So we have admin expense, 11,270, right? Okay, but there's, I think these are total expense. But then there's something here. The business is to pay 2,500,000 commission to Banks Limited. The transaction, which is also subject to withholding tax, has not been captured. Okay. So what do we do? Remember, this commission from the perspective of the business here is an expense. But from the perspective of Blinks Limited is an income. And I've already taught you withholding tax, accounting for withholding tax. You can go and take that class on Jarvis Consulting. Okay, we talked about what the inland revenue, request that we do when we're paying for certain items. We talked about dividends, interest, commission, consultancies, okay, equipment rentals and hires and all that. Directors' fees. We talked about all that in that class. When we are paying for items like that, we are expected to charge withholding tax. So depending whether it is an individual or a company, okay, it can either be 10% or less. But for commission, here is 10%. Okay, because it is for what? A company. So I can see Blinks Limited here. So we have 10%. So it means that if we are paying this guy his commission, we are going to pay him less 10%. So what that means is that he is going to take an amount less. This 2.5 now will be less 10%. Then the 10% that we have deducted, we expect to remit it to the what? Federal Inland Revenue Service. I already explained this in the accounting for withholding tax. I'm going to take that class. Okay. So now, what is the basic entry for this? Of course, commission is an expense in this case. From this perspective here, it's an expense. So we are to pay. We have not paid. If we were paying, it would have been credit, cash, debit, commission. But now we have not paid, so we are going to adjust for this in the report. So what do? We have to debit what? Commission expense, right? Which is 2,500,000, and then we credit Blinks Limited with how much? We can't credit him with the total amount because we are going to pay him less. So he's going to be what? 10 over what? 100 times 2,500,000. Okay? This cancels this, this cancels this. So what do you have there? 250,000. Yeah? So that means we're going to have a credit here for what? The Federal Inland Revenue Service, which is the same thing as what? Withholding tax on payables. That would be what? 250,000. So we are going to credit Blinks with what? 2.5 million minus 250,000. Okay, so that is 2,250,000. Okay, so it means that this guy is not going to collect the full money. We're going to reduce it by 10%, which we're going to give to what? Federal Inland Revenue Service as withholding tax on what? Payable. So I already explained that in the class for accounting for what? Withholding tax. So I advise you, I encourage you to go and take that class so you understand what we're talking about here. Okay, so we're going to have to adjust for this in the what? Report. So if you're debiting commission expense with 2.5 million, it means our admin expense will increase. So this is more like what? This is more like accruals. And then if you look at it again, it's more like an error of what? Omission. I told you about mistakes that can happen because of various reasons can cause errors. So long as it's not intentional, otherwise you might begin to interpret that as fraud, where it's intentional. But this is not intentional. If it's not intentional, then it's an error that needs to be what? Reinstated or corrected. Okay, so this is an error of omission. And then in it, I can see accrued expenses. Okay, so now we're trying to what? Reinstate it. We're trying to what? Capture it in the what? In the report. Okay, so what do we have here? What do we have? So we're going to say what? Commission. Commission what? Expense. How much is that? That will be 2,500,000. Of course, in our what? Balance sheet or statement of financial position, this guy here is what? A liability because we are owing him 2,250,000. We are also owing what? FRS. How much? 250,000 on behalf of what? Blinks, of course. Of course, we expect Blinks to utilize this money now to reduce his own what? His company income tax when he's filing returns. Okay, so take that class on withholding tax. You understand what I'm saying here? Okay, and if you've been following us, this shouldn't be an issue anyway. So we have conveyance expenses, yes, 2,500,000. So the next one that we have, the business rented a new office, okay, on the first of the 7th month. The business paid for a year at a cost of 1,500,000 per annum. So of course, the rent is what? 1,500,000, and that is for a year, right? 12 months. So it is beginning in the first month of what? In the first of the 7th month, which is July. So July to December, that's what? 6 months. So the business paid. That means they've already paid. So apparently they must have captured it in the what? Admin expenses. So we have to adjust for it. So understand also that there's an issue of withholding tax here. But because they say business paid, let us assume that the business has already deducted and remitted. So that we can let's be straightforward. Otherwise, we can begin to say, okay, there's an issue of what? Withholding tax that we must have to what? Adjust for. But let's not make it complicated, because on the field it's not that, again, you know what's happening, so you can tell what's happening. So let's assume that what? Since they say it has been paid for, let's assume that withholding tax has been deducted and remitted. Okay? And then let's adjust for the prepayment that is here now. So we're saying that the business did what? The business rented an office, but it started counting on the first day of the 7th month, which is July. And because they are already paid, apparently they've already captured everything here, which is not supposed to be so. So that means what we are supposed to capture is 6 months. So 6 months is half of this. So what is half of 1,500,000? I think that's what? 1,500,000 divided by 2. I think that's a. So apparently, remember I said prepayments at the end of the period reduces what? The expense or income item for that period, depending on what you're adjusting it with. In this case, you're adjusting it with what? Admin expense. So apparently, the 750,000, which is the prepaid item here, or prepaid expense here, will reduce the what? Admin expense. Okay? So of course, we're going to say what? Prepaid what? Rent. 750,000, but it's going to be in brackets. That's because they've already captured it in this total expense here. So we're just going to have to adjust for it. What they've captured is 1.5. What we're supposed to take into account is 750. So we're supposed to reduce it by what? 750. So in that case, this 750 now becomes what? That's that part that has not been used. You know, it's 1.5 for 12 months. We have used 6 months by virtue of July to December. But the one that is yet to use, which is going to be expired the following year, becomes an asset. So that means the landlord is still owing us for 6 months. Okay? So that's prepaid expense. The current what? The current asset. So that's it. Okay? So that's it for the rent. So the office assistant have excuse me. The office assistants have claims of 125,000 spent from their personal purse while moving equipment to the new office. This is yet to be settled. So this is more like testing accrued expense. So what do we call that? Should we say they were moving? Okay, that's more like transportation. Okay, the other assistants have claims of 125 spent from their personal purse while moving equipment to the new. That's like transportation, right? So we have something like accrued transfer, because the company is now owing. I told you another word for accruals is what? Outstandings or what? Or owing. So now they are saying that the office assistants have claims of 425,000 naira spent from their personal purse while moving equipment to the new office. So that means they have spent it on behalf of the business. The business is yet to pay them. So the business is owing them. Okay, so that's accrued expense. Okay, so we're going to have what? Let's call it transport. That's 250. Excuse me. 125,000. Okay, so that's it for that one. Then they said it is the policy of the business to depreciate non-current asset by 20%. So what's the non-current asset in the question there? 29,500. So depreciation, what do you have there? You have 0.2 times 29,500. So what do you have? 0.2 times 29,500. I have 5,900. So any other expense item there? Can't find any. So let's go. Total expense. So what do we have? 5,900 plus 125. This is deduction minus 750 plus 2,500 plus 11,270. I have 19,045. So here we have 19,045. So let's take this out. Okay. What I have is 19,455. 19,455. So let's just check again. Let's check again. 96,000 minus 57,500. Okay, 38,500. Then minus 19,045. So this is the profit for the year. Of course, that's your reserve. Then if the business wants to pay, maybe make provisions for tax and all that, then you can deduce all that from here. Okay, remember, I already explained that reserves also form part of earnings of the business. So it means that the business has made 19,455,000 for the year. So whatever they want to do with it is left to the management or board of directors or the owners. Okay, or whoever is in charge with managing the business, and then it will be a reserve until they decide on how to use the profit. So sometimes they can want to pay dividends, make provision for tax and all that. So once that is reducing because they've not paid, you can declare dividend, you can propose dividend without paying. So that means you're paying the following year. So in the year you're reporting, that dividend becomes a liability that you're owing to what? Shareholders. So that will also reduce what? The profit element. If you make provision for tax, of course you are not paying in that reporting period, you're paying the following period. That will also reduce your profit, but that will be a liability. Okay? But in this case, the business is not even making any provision for it, so we're just assuming that this is everything that will be in the reserve until they decide on how to utilize it. Okay? So let's go. Let's prepare the statement of financial position quickly. I'm taking this off, but remember, we're going to account for this too. We've accounted for this here. We're going to account for this in the statement of financial position. So let me just put that somewhere here. So what did we do? We debited commission, okay, expense with what? 2,500,000, right? We credited what? Blinks Limited with what? 2,250,000, and then we credited what? FIRS or what? Withholding tax on what? On payables, 250,000. Okay, so let's prepare the statement of financial position. Let's go now. So let's call this statement of what? Financial what? Position as at what? 31st December 2017. Okay? Right? So these are what? Assets. So what's the first one there? So let's call this notes. So this is non-current assets. Okay? Also called fixed assets. Let's call it note what? 4. So this is our note 4. Alright, so what do we have there? The question says property, plants, and equipment. So we have property, plants, and what? Equipment. So how much do you have there? 29,500. So we have 29,500. 29,500. So what do we have? We take out our what? Accumulated depreciation, right? And that would be what? Accumulated here, I can see 6,000. Then the one for the year, I can see 5,900. So we have 6,000 plus 5,900. So what do we have? 6,000 plus 5,900. We have 11,900. 11,900. So if you take that out, what do you have? You have 17,600. So this is your what? Net book value, or carrying what? Amount. So that means here we have 17,600. So then we have current asset. Let's call that note what? 5. So we have note 5. So what are the current asset items here? I can see cash at bank. Okay. So we have bank. What's the bank there? 25,000. What's the next one? Receivables. Start like your debtors. What do we have? 20,000. Remember, prepaid rent. You paid for rent in advance. That means the landlord is still owing you. That's more like an asset as a debtor. The guy is owing as a debtor. So it becomes what? A current asset. What do you have there? 750. What else? What else? What else? What else? What else? What else? That's all. So what do we have? What do we have? What do we have? 25,000 plus 20,000 plus 750. 45,750. 45,750. So we have 45,750. So when you add this up, plus what? 17,600. I have 63,350. Okay, so then let's go. Liabilities. Long-term liability. Let's go. Note what? Let's call that note 6. So let's go. Note 6. What do you have? I can see bank loan. Bank loan there. How much is that? 7,500,000. So we have 7,500. So that's about it. 7,500. So short-term liability, note 7. So let's call that note 7. What are the short-term liabilities there? I can see payables. Payables here, 12,500. I can see VAT. VAT here is what? 1,270. 1,270. What else? What else? What else? What else? What else? Remember, we have accrued transport. Remember accrued transport? Okay, we were owing the cleaners 125,000. Okay, so we have accrued expense. Okay, so we have accrued expense there. That's 125. Okay, so what's the next item there? Okay, remember that this guy, Blink Limited, we're there to pay him. We are owing him 2,250,000. So we're going to say what? Blinks, how much? 2,250,000. Then this guy, withholding tax on payable, which is FIRS. Withholding tax on what? Payable. That's 250. Okay. So what we're saying is that the guy is entitled to commission that we want to withhold tax on. That's 10% tax. That's Blinks Limited. It's a company actually. Okay. And then remember, we're here to pay them. So that's why we're crediting them here. They're more like vendors, or they're more like creditors to us. But we're not going to credit them the full amount because we're deducting what? We told the tax that we're going to remit to what? To the Inland Revenue Service. Yes. That's what you have there. So, but that payment will be the following period anyway. So in that case, we're paying him now. What we do? Credit bank and debit him for remitting the money to Inland Revenue Service. What? To credit bank and what? Debit this. And remember, I told you there must be a schedule that gives detail of this transaction so that it will give the revenue service an information regarding that for deduction. And then we also expected as the accountant to follow up to get a credit note on behalf of Blinks Limited so that Blink can use it or utilize it to reduce his company income tax. Okay, so that is it for the current liability, I guess. Let's check any other item there. Is there any other item there? So we've done all. Okay. So let's add up. Let's add up. We have 12,500 plus 1,270 plus 125 plus 2,250 plus 250. So what do I have here? I have 16,395. So this is what? 16,395. Okay. So what's the next thing now? We have our reserve. Note 8. Let's call that note 8 here. So what's the reserve there? That's the profit you made for the year. Remember, the profit, okay, has not been shared or utilized, so it's going to be reserved. But if the board has decided to pay dividend and all that, it will reduce the profit, but it will also increase the liability. So if the board, for instance, decided to pay dividend of, let's say, 9 9,455. So that will reduce this to 10 million, right? That's 10,000. So if the board say, okay, let us use 9,455 as dividend. So that means that the profit that will go to reserve will be what? 10 million, which is 10,000. But this 9,455, which is proposed dividend, will form part of the liability because it is proposed, it's not yet paid. So that means the reserve has reduced, the profit has reduced since the board wants to what? Pay owners of the business or investors. The same way, if they want to make provision, maybe out of the remaining 10, they say let me provision for 2 million. That means the profit reduced further to 8. That means the reserve will be what? 8. Then the provision for tax will be part of the liability where if maybe we have not paid. So the liability will increase by the dividend you propose and the what tax you also make provision for. Okay? But in this case, we are not making any provision. So let's just assume that the whole 19,455 is going to be in the reserve until we decide on what to do with it. So we can say reserve will be profit for the year B, which is what? 19,455. So our reserve will be what? 19,455. Okay? So what's the next item there? The next item there that we're here to pick, I can see that we're here to pick our share capital. What's share capital? 20 million. What's our share capital there? We have 20 million. So we'll say share capital. What do you have? 20 million, right? So that's it. So let's check. We have 7,500 plus 16,395 plus 19,455 plus 20,000. So what do I have? I have 63,350. So this is your what? Total assets. This is your what? Total liabilities. So I can see at the end of the period, the total asset is 63,350,000. Is represented by a total liability of 63,350,000. So this is, a brief or straight to the point illustration, helping us understand how to make adjustment for prepayments and what accruals. So if you have questions, you can reach me on the number displayed up there to reply you with the right answers. Okay, and then remember, you can support us by paying to the account displayed, okay, or sponsor my textbook so we can distribute to students for free. I want to say a special thank you to the MD of Stewards and Designs Limited, Nigeria Limited, okay, for sponsoring copies of my textbook. Thank you. I'm expecting you as well, okay. Be a good person by either sponsoring textbooks or supporting what we're doing by paying to the account displayed on the screen. Thank you.